For our audience worldwide, good evening and welcome to Money Matters on another week. Today's diary, we will look at business news, commodity markets, forex market, and the conversation. I am Malik M. Jallo, and this is Money Matters. Welcome back, viewers. We will now look at the business headline. At the 2022 World Bank meeting in Washington, D.C., the Gambia's Finance Minister, Sidi Keita, stated that the spike in food and energy prices has left an untold challenge on the Gambia government and on its people. We will quickly take a look at the business headline.
Thank you very much. Gambia is a net energy importer. We import all our energy needs, and the spike in the price of energy as well as food had left an untold challenge on both the government and the population of the Gambia. It has put a stress on our fragile economy, and with the intervention of the World Bank, we have been able to invest in a mix of energy that support the energy roadmap, which overall will consist of the alternative energy production. We also have the regional power supply from Senegal, as well as the existing hydrocarbon power production. That, on completion, will reduce the overall energy mix and the subsequent price reduction. The shock has not been very easy on the population and the government treasury for that matter. We were obliged to subsidize the price of fuel to the tune of $1.5 billion in the last 7 months, which translates to about $30 million to cushion the impact of the society. That notwithstanding, it left a big gap in our fiscal space, but we felt it was necessary as a government in order to ameliorate the shock or the pressure on the population.
Welcome back. That was the business headline, and we have clearly seen what the Minister of Finance has mentioned. Let's move on to the international foreign exchange market, and we look at how currencies have been faring. The dollar has remained stronger or stable over the week. Dalasi as well has remained stable against the dollar. It opened at 55.59 and closed at 56.19. The chart indicates a stable movement, and it also shows that the dollar peaked at 56.26. This indicates that dollar still remains a safe haven for investors. As we have already stated, it is an important currency when we do international trade. Euro Dalasi. The euro opened at 53.90 and peaked at 54.94 and closed at 54.64. This has indicated a bit of recovery on the euro as expectations have been formulated around the future policy direction of the ECB. Christine Lagarde, the president of the European Central Bank, has indicated their intention to continue to hike the monetary policy rate to stabilize the euro. Pounds to Dalasi. Pound opened at 61.55 at the beginning of the week, quickly dropped to 60.95 and peaked at 63.56. At the end of the week, it closed at 62.78. Pound sterling has been one of the most volatile currency recently, as the direction of the fiscal authorities and the Liz Truss's administration in terms of fiscal direction has not been very clear, and this has raised uncertainties in the markets, as we have seen when she instituted or when she took the decision to cut taxes of the top wealthy people, which the markets are not sure where the source of financing would be from. This has seen the pound tumble down, and it continued to remain volatile. Let's look at the international cross rates, which is, we take a look at other currencies against the dollar. The dollar remained dominant. Pound sterling opened at 1.1 and peaked at 1.13 and quickly dropped to 1.11. This is as a result of Liz Truss administration. She fired the Exchequer of the Chancellor of Exchequer, Kwarteng, who was advancing her policy, her fiscal policy direction. This led to an immediate shock in the financial markets, specifically in the foreign exchange market, and also raised the uncertainty and put in question whether the markets really have confidence in the Liz Truss administration to steer the direction of the economy. Euro recovered a little bit at its peak at 0.977, which is still below parity. But both currencies, both euro and pound, dropped against the dollar on the 13th to the 14th of this month. Dollar remained stronger, and this has been according to forecast. We expect the dollar to remain strong given the uncertainty surrounding the European Union energy crisis exacerbated by the Russia-Ukraine war and also supply chain bottlenecks. This is also enhanced by the China zero policy, COVID zero policy lockdowns that has steered the fear of global recession. We will look at the commodity markets. Commodities have been relatively on the drop. The crude oil opened at $99 per barrel, but closed at 92. Over this week, the OPEC has indicated its intention to cut down global oil supply. This has been supported by the fact that the IMF has slashed global growth, and as inflation spiked across the world economy, demand has been steering down, and the second largest economy in the world, which is China, still maintains its stance on COVID zero policy, enhancing lockdowns and also curtailing consumer expenditure. For this reason, OPEC and other oil producing corporations or countries have decided to reduce their supply. Gold also opened at 1,700 and closed at 1,640. It's a commodity that is being used as hedge against inflation. Therefore, a drop in its price indicates that investors really have confidence in the ability of the Federal Reserve to steer the monetary policy of the United States in the right direction, and this increases their appetite for dollar, as expectations continue to be that the Federal Reserve will continue to hike interest rates by 75 basis points to tighten financial conditions and fight inflation. Rice has been very, very stable. It opened at 18.85, 16.85 and closed at 16.70. That was the commodity markets and the foreign exchange market. When we are back, we will look at the conversation segment. Welcome back. Now we're getting to the conversation segment. Today, our topic of discussion is driven by the recent press release by the OMCs. That is the shortage of dollars in the economy and its impact on the ability of OMCs to settle their suppliers, as they have claimed in their press release. I must mention that conversations have been going on with the OMCs and the Office of the Vice President, and the proposed halt in operations have been called off. However, we find it absolutely necessary to discuss on this topic. And with me today, I have Mr. Suleiman Marena. Mr. Marena is the Asset Liability Management Officer at Ecobank Gambia, and it's my pleasure to welcome you on Money Matters, Mr. Marena.
Thank you so much, Malik. It's a pleasure to be here as well.
Great. Let's go straight to the point. The press release, oil is a key commodity it's a backbone of the economy. Energy, everything is driven when there is energy, from electricity to computers being, enabled to work, to cars, transportation. Basically, it's a basic commodity. But what I'm more interested in is the source of financing to pay for these bills. And as they claim that banks do not have FX to issue letters of credit. So what would you say to that claim? Do we really have dollar shortage in the banking system?
Thank you once again. And yes, it's true, there is dollar shortage in the markets. As of today, banks can hardly meet half of the customers' need when it comes to USD. In fact, this has contributed significantly to the massive increment of commodity prices in the country.
Mr. Marena, letters of credit. Can you just give us a brief description of letter of credit and how commercial banks fund for letter of credit?
Thank you. Letter of credit is a credit line that banks usually give to their customers. In case of the failure from the customer not paying, settling the LC, then banks will step in and take the responsibility of funding these loans that they took from their suppliers. And well, how banks fund these letter of credits as the LC is through buying FX from the providers. So as we are right now, the situation in the market is that there is shortage of FX in the market. So that being the case, banks are finding it difficult to give LCs to their customers.
Right. So from what you've said, it's a commitment, irrevocable, that the banks have to put in place for their customers, pledging to the suppliers of the importer that if the importer is unable to settle, we will step in and settle. But again, you have to purchase this and fund your account and commit those funds. So which means, from what you have said, that the sources of supply, that is MTO selling you, is drying down, and also bureaus, the ability for them to sell you cash is also drying out. And this is putting constraints, because if you commit the dollars that you have in your deposits, those are customers' deposits. You need to be able to refund it as quickly as possible. So let's move on to that. From that, the sources of supply. Okay, why do you think dollar supply is drying up at the moment?
The causes of dollar shortage is mainly there is an increase of demand on the dollars. You can see Gambia is an import country. Our import of goods has increased year on year. According to the central banks, year on year it has increased to 12.9% from 2001 to 2002. So that being the case, that will put a constraint on the dollar needs in the market.
Great. In the Gambia's FX market, we have two parallel markets. We have the official market, which is what is reported by the commercial banks. And we have what I call the shallow market. So we have small participants in the shallow market, and the liquidity in the market is very tight. So every small seller is looking for a margin. So which means you will have higher prices of the FX that you are demanding, whether dollar or euro. So you see the onshore trading, the difference between the onshore and offshore trading, the margin is so big. We just look at the foreign exchange market, and dollar to dollar is at 56, is close at 56. But if you go to the domestic market right now, if you go to the banks, probably you will have close to 55, 56, or around that area. But if you go to the parallel market, the shallow markets, you have dollar going up to 63 or 62. The OMC claims that the pricing model used by the Ministry of Finance is indicating dollar is 55, but they are getting these dollars at 62, which means two things, which I will let you help me answer. Does that mean they are getting the dollars in the banks, from the banks, or not? That's one. Two, this shallow market, how do we ensure that the trading, the gap between the onshore and offshore, the rate, why is it so big?
Right. But the commodity traders or the MTOs cannot actually get the required effects, all the required effects they need for their business from the bank. Banks are really struggling when it comes to FX. It's the MTOs, that is the money transfer organizations, that have the FX. So they sometimes are feeling it hard to sell it to the banks because of the rates. They prefer selling it outside market at a higher rate than coming to the banks to sell it. Now, what these banks do is we buy the FX from these MTOs at a rate and we resell it to these end users and make our margin. So now what the MTOs are doing now, they're dealing directly with the end users. So that is making it very difficult for banks to come in here, because we cannot buy at a higher rate from the MTOs and sell it at the same rate to the end users. That is making it very, very difficult for us.
So which means the margin between the onshore and the offshore trading, because onshore, when you're buying, you look at the international market. That will help you to trade, to buy from them. And when you are selling, you also look at the international market, because you have corresponding relationship. But some of these third parties they are selling to, they don't have corresponding users. But the transaction end up being executed through the banks. So first, the margin, why is it so big between the international market and the domestic? And how do we get it closer? The role of the regulator, the financial regulator, to make sure this gap is closed, to encourage money transfer operators to sell to bank directly, which will ensure the efficiency of the transmission mechanism in the trading market.
Well, the margin between the offshore and the onshore have to do with the demand and supply. You know, yes, I will agree with you that offshore the dollar rate might have gone down, but onshore you realize because of the shortage surrounding the FX market will make it very difficult for us to merge the rate or to close the gap. So for commercial banks to close this gap between the offshore and the onshore, that means the central bank force need to tackle the how to call it, the FX availability in the market. And doing so, I think the central bank or the regulators need to force target, put in place controls, right? The MTOs that are bringing the FX need to be controlled, because what we've realized is now MTOs are dealing directly with the end users, which is not a good practice. MTOs should deal directly with the banks, and the banks will deal directly, because we are regulated by the central banks. So that would really help, I think, if the central banks.
But I agree with you, but from a business perspective, I'm a businessman. I have an MTO. I have expenses, I have costs that I incur to run my business. So if there is arbitrage opportunity, I will take the arbitrage opportunity. So there should be, what should we do to incentivize? Because if you want to force, if you intervene by direct policy intervention, command intervention, instead of market intervention, you are going to create an alternative route that they would take. So what do you think the reference rate that the central bank has, that MTOs are supposed to use as a benchmark rate to set their rates, to set their order rates or their trading rates? Do you think that rate is too far from the parity, the gap between that rate and the onshore, offshore trading is too wide, that the MTOs are aware of this and they know that given the demand that you have mentioned, they're aware and they want to take advantage? That reference rate, should there be any policy that indicates if international is doing this, the difference between what MTOs are selling to you as the bank should be a certain margin that is close to international, and then what you will be selling to the other parties, to commodity importers, should also be a certain margin. Let's just take an imaginary 2%, okay? But if you look at the central bank reference rate, it is at 52. International is at 55. So if I am an MTO, how do you make that adjustment?
Well, the reference rate is there for the MTOs to use as a benchmark. But what we realize is it's very difficult for the MTOs to benchmark this. I don't know, for one reason or the other. So what the central banks need to do, there should be a proper control in place, making sure, okay, this is the reference rate we have in our how to call it, in our platform. So MTOs need to make sure, even if they cannot use that reference rate, but at least 2% different margin should be between it. But the gap between the reference rate today and the international market, and it's really huge.
The bureaus, you buy the MTOs inflows, but from bureaus you buy cash.
Right.
What do you think will be the case if all cash sales that are going to the bureaus have been directed to the banks? you come with your cash you have and you want to sell it, instead of going to the bureaus, you direct to the banks. I know bureaus play an important role because there are certain areas that banks will not be established, and bureaus play an important role for financial integration in those areas. But in a well-centered area right now, what would you think the impact of that would be if all this cash that you are purchasing from bureaus, leading you to put up a higher margin, have directly come to you and you purchase it directly from the customers who have the cash? What the impact would that be?
Well, this will help us mitigate the rise in FX rate, because we've realized customers that are going to the bureaus directly selling their FX is at a higher rate, and for us to buy from those bureaus again have to cost us a higher rate, and for us to sell it again to the end users have to cost them a lot. So that if the FX bureaus can sell it directly to the bank at a margin, at least that will help us mitigate the rise in commodity price. And so that will help us mitigate the high foreign currency rate in the country.
Yeah, so the last question, and probably we will conclude with that. The central bank stated earlier that the Gambia has at least 4-month import cover, that is the reserves to finance import cover. Do you think we are running out of those reserves right now?
Well, yes, if you ask me, we're running out of those reserves right now, and in 4 months' time, I think it will be a bit short for us to cover those, on my honest opinion.
Thank you, Mr. Marena. Time was short, but you have done justice in your deliberations. We have looked at the foreign exchange market. We have seen how dollar remained dominant, and we have seen that it has remained steady and stronger against a euro and a pound sterling. And we have also seen that pound sterling tumbled down on Friday as Liz Truss fires Kwarteng. The euro recovered a little bit, but it's still below the inception. It's still below parity. And we have also seen that oil, or crude oil, has not been going very high rapidly, as fears of demand in the global economy to go down. Saudi and its OPEC allies have decided to cut their output by 2 million barrels per day. We have also seen in our business headline that the minister at the Washington, D.C. World Bank meeting indicated how tough times as a result of high energy and food prices are being hampered on the Gambia's government and its people. And the last we looked at was the foreign exchange market and its impact on the ability of OMCs to settle their important bills. Mr. Marena deliberated on those issues. So the fact remains that dollar will remain stronger and FX shortages will be here for a while. So let's brace up for more. This was Money Matters today, until we come your way next week. Thank you.